There's a moment every trader knows. You're up $4,000 on the week. The market's moving your way. You feel invincible, so you double your size. Then triple it, and within 48 hours, it's all gone. Every dollar, plus some of your own. I've been there. Most serious traders have. But here's what nobody talks about. That wasn't a bad trade. That was a bad bet. And understanding the difference between those two things, that is what separates traders who last from traders who flame out. Today, we're going to talk about position sizing, not the glamorous part of trading. Not the setups, not the indicators, not the entries. The math that actually determines whether you survive this game long enough to become good at it. Let's start with some hard data, so we're all on the same page. According to studies from FINRA and various academic institutions, roughly 70 to 80% of retail day traders lose money over any given 12-month period. Another study from the University of California, Davis, found that only about 1% of day traders are able to consistently profit after accounting for transaction costs. Now, before you say those are other people, not me, let's ask why that number is so high. Is it because retail traders can't read charts? No, there are hundreds of thousands of traders who understand technical analysis at a sophisticated level. Is it because retail traders don't have access to information? No. In 2025, a retail trader in Kansas City has access to the same earnings data, the same macro reports, the same price feeds as most institutional participants. So what is it? It's survival. Most retail traders blow up before they ever develop the skill to become consistently profitable. And the number one reason traders blow up isn't bad analysis. It's oversizing positions. Think about it this way. You can be right 60% of the time, which frankly is excellent, and still lose your entire account if the 40% of losing trades are sized 3 times larger than your winners. That's not a strategy problem. That's a math problem, and math doesn't care how confident you feel. Here's where the story gets real, because I want to talk about why traders oversize. It's not stupidity, it's psychology. The first trap is called the illusion of competence. You've had a good month. Your last 5 trades all worked. You start to believe your edge is bigger than it actually is. So naturally, you increase size. What you don't realize is that markets are mean reverting, not just in price, but in performance. That hot streak was partially skill and partially variance. Increasing size right at the peak of a variance cycle is one of the most common ways traders destroy months of work in a single week. The second trap is revenge trading after a loss. You take a $1,500 loss on a trade that should have worked. Your ego says, make it back. So you go into the next trade at twice the size, trying to recover quickly. But your emotional state is compromised. Your decision-making is compromised. You're no longer trading as setups. You're trading feelings. This is where $1,500 losses become $8,000 losses by end of day. I want to give you a real example of what this looks like mathematically. Say your normal risk per trade is $200. You have a 55% win rate, and your average winner is 1.5x your average loser. Run the math over 100 trades. You're net positive. Solid. Now take the same trader, same system, same win rate, but after a bad week, they start risking $800 per trade trying to recover. One bad string of 5 consecutive losses, which statistically will happen to everyone, and they're down $4,000. That's not a system failure. That's a sizing failure. The third trap is FOMO-Driven oversizing. NVDA is running 5% in pre-market. You don't have a setup, you haven't done your analysis, but you can feel the move, and you go in heavy. The stock gaps up, pulls back hard, and you're holding a full position into a reversal with no plan for how to exit. This scenario plays out every single earnings cycle in the U.S. market. The brutal truth is this: the market will always give you another opportunity. Missing one move costs you nothing. Oversizing on the wrong move can cost you everything. So what does trading smaller actually look like in practice? Let me give you a concrete framework. Rule number 1. Never risk more than 1% of your account on a single trade. This is not new advice. This is advice that has been given by every serious trader, from Paul Tudor Jones to Mark Minervini, and yet the vast majority of retail traders routinely risk 5 10, even 20% of their account on a single position. If you have a $25,000 account, which is also the pattern day trader minimum in the US, 1% risk means your maximum loss on any trade is $250. That means you can have 10 consecutive losing trades and still have 90% of your capital intact. Your account survives. You live to trade another day.
Rule number 2, scale size to conviction and to liquidity. Not every trade is created equal. Some setups have confluence, multiple technical factors aligning, strong sector rotation, clean volume patterns. Others are more speculative. Your position size should reflect that reality. A high conviction trade might warrant 0.75% risk. A lower conviction exploratory trade, 0.25%. Also, be aware of liquidity. Retail traders often size into stocks or options with thin order books where their own entry moves the market against them. If you're trading a stock averaging 300,000 shares a day and you're trying to buy 5,000 shares, you are the volume event.
Rule number 3, define your max daily drawdown before the market opens. Professional prop trading firms do this by default. They give traders a daily loss limit. When you hit it, you stop. Period. As a retail trader, you need to self-impose this discipline. A reasonable starting point is 3% of account equity per day. If you hit it, log off. The market will be open tomorrow. Rule number 4, use share size calculators, not gut feel. There are free position sizing calculators available on platforms like TradeStation, Thinkorswim, and standalone tools like MyFX Books Calculator. Input your account size, your risk percentage, your stop distance,
and it tells you exactly how many shares or contracts to trade. Remove the emotion from sizing entirely. Rule number 5, let the results compound before you scale. This is the most counterintuitive one. Most traders want to grow their position size as fast as possible, but the correct approach is prove your edge at small size first. Be consistently profitable for at least 90 trading days before you meaningfully increase your risk per trade. The market isn't going anywhere. Your edge, if it's real, will still be there when you're sized larger. I want to leave you with one final thought. The traders who make it, the ones who are still trading 5, 10, 20 years from now, they don't have the most dramatic stories. They don't have the $10,000 days they screenshot for social media. They have equity curves that go up and to the right, slowly, steadily, reliably. Trading is not a sprint. It is the longest game you will ever play. And the only way to win a long game is to still be in it. When you trade too big, you're not betting on your analysis. You're betting on your ability to absorb a catastrophic loss. And that is a bet the market will eventually collect on. Trade smaller. Stay longer, compound quietly. That is the entire secret. If this video hit close to home, if you've had that account-blowing moment, or you can feel yourself creeping toward one, drop a comment below. Tell me your position sizing rule right now. What percentage are you risking per trade? I read every comment. If you're new here, subscribe. We cover technical analysis, macro setups, and retail trading education every week for the US market. No hype, no alerts, just real education. Trade smart. See you in the next one.